I don't think the Feds can really raise a lot more. The talk is that they're going to reverse. And I believe that one of the things that's going to force their hand, other than just demand destruction, more middle Americans getting crushed by debt, by an inflation that you and I have talked about this on your previous shows, that inflation is held at about 20% increase over what it was 3 years ago.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, hey, we're in the third week of January here. We got good news on the consumer sentiment front. Consumer sentiment has gone up last couple of months. Is that enough to combat the rising credit card debt, higher foreclosures, weaker earnings by banks? David Wright is with us now, financial expert. And David, it's great to have you back on the show. So what are you making of all these rosy numbers here on consumer sentiment and spending and such? Is it too little, too late?
Kerry, thanks for having me back. I appreciate it. It's always great to talk with you. I think that the numbers are indicative of consumer habits. They like to spend money, and I think people, as long as they have room in their credit card balances to continue to use their credit, to feel happy about the fact that that the inflation picture, at least on paper, looks like it's coming down in the right direction. The stock market has certainly exhibited those behaviors of the belief that they think the Feds are going to start reducing higher interest rates, which is going to reduce strain on banks, reduce credit card debt down the road, perhaps open up the housing market. So from the last report, Kerry, University of Michigan consumer sentiment increase was 13%. People viewing their own personal situation, an improvement of 13%, going from 69.7 on the index up to 78.8% on the index. People's opinion of outlook on near-term business conditions, up 13% on that as well. Their reading, however, on people's outlook on longer-term business conditions was a point below that, well, plus 12%. So not quite as bullish on the longer-term outlook, because let's get real, this is an election year, and there's still a lot of variables out there with what's going on in our world.
All right. So where does that leave us here? Is the economy expanding? Lower interest rates? Is it going to make any difference? Or are we kind of locked in here?
I think for right now, the economy is basically gonna stay at a stalemate. Right now, as long as the Feds stay higher for longer, which they, of course, have given different signals. The problem is with this Federal Reserve System, with every Fed president having their day to talk to the press, they each have their own opinions on how they believe they're going to vote as far as increases, decreases, or staying the same throughout the rest of the year. I believe, personally, with the data that I read, we've gone from first it was 3 rate reductions, then the market started baking in 5 to 6 rate reductions by the end of the year. And now, Kerry, just in the last few days, I'm starting to read news about perhaps a hold, if not wait till June or even third quarter before they would even begin to reduce rates. I even heard somebody, Bostic, I think it was, the Fed president, Bostic, mention that there might even be a rate hike this year. So there's so many mixed signals out there, and I think the reality is we just have the things that the Feds look for: low unemployment. We have very low unemployment right now. That continues at 3.7%. We certainly have stabilized inflation. It's gone down from 9.1 all the way back down to, I think the core CPI, Kerry, was in the mid threes, 3.1 to 3.5-ish, 3.5-ish. And I know the Fed, their target mandate is 2%. So they're not quite there yet. My guess is with still $6 trillion of cash sitting out there waiting to be spent, either by consumers or by corporations and pension funds, that there's still going to be some chance of a robust market. But where's the Fed going to go? Are they going to go political like they have in the past? Are they going to help the stock market out by lowering rates, which we believe would definitely help the market continue to show a rise in the new year? Or do they basically say, hey, if we're at 5.25% to 5.5% on the federal funds rate, and the stock market had a record year last year, now, yes, it was propped up by these Mag 7 stocks. Sure. Why would we reduce rates right now if everything's looking better, lower unemployment, stock market's doing well? Maybe the Fed just says, you know what? If it ain't broke, don't fix it. We're going to hold higher for longer, and we're going to wait and see if we can create more demand destruction of the middle class. And the reality is there is demand destruction going on right now with middle class, as far as credit card borrowing amounts spiking in the last quarter, revolving credit up 19.5 billion last quarter. Foreclosure activity on houses increases from 2022. We had 324,000 foreclosures in 2022. In 2023, we had 357,000. So that number has increased. More people foreclosing, going out of their mortgages. So I don't know. You tell me.
Well, if I knew that, I would give up my computer here, my keyboard, for a crystal ball. But certainly it looks like, well, I remember the late, great Alan Abelson, editor-in-chief of Barron's, used to say the Federal Reserve is doing what it does best, and that's electing a president, right? For the more cynical of them.
I love it. Yes, there you go. I had not heard that quote, but yeah. I don't think the Feds can really raise a lot more. I mean, the talk is that they're going to reverse. And I believe that one of the things that's going to force their hand, other than just demand destruction, more middle Americans getting crushed by debt, by an inflation that you and I have talked about this on your previous shows, that inflation is held at about 20% increase over what it was 3 years ago. The rate of acceleration has declined, but certainly inflation has held at 20%. So the question that I think the Feds are going to have to ask themselves is, staying higher for longer is going to rear its ugly head with banking in our country. I think the larger banks, all their earnings were published last week, I believe. A lot of the biggies, the biggest being JP Morgan, Chase, and Bank of America. A lot of their earnings were meh. But that's understandable because they all had to pay this FDIC settlement check for the bailout last year. So they all got hit with that surtax. But still, even and despite that, these larger banks that are kind of too big to fail banks, not as worried about them, but their earnings were kind of lackluster. Most of them were a little lower. What I think the Feds are going to think about are the 4,000 plus regional banks that are out there that can't really take a lot more squeeze on their net interest margins, the difference between what they pay their depositors and what they make on their own loans. I don't think the Feds can squeeze a lot more on interest rate hikes or holding higher for a lot longer. I think at some point they want the American consumers' belief in the financial system to remain there long term. So I think we'll get our rate reductions, but I think it's going to be more towards the middle to later part of the year. But depending upon political pressures, you just pointed one out. I think we'll see.
So they're just going to put it off for as long as they possibly can, huh?
I think so. I think that's what they'll do. Personally, there's too much. I don't have my dot plot up here to take a look at it, but there's enough difference of opinions from one side to the other side of the Fed that it's tough to really decide which way they're going to go with it at this point. It's hard to read Powell's which way he's going to go with it. But for one thing, for sure, Kerry, it's definitely a tightrope walk between making the right and the wrong move. And I don't even know if there is a right or wrong move. When you create artificial money and stimulus, it's tough to walk that stuff back without having consequences.
Yeah, once you release the inflation genie from the bottle, it's hard to get it back in. And clearly they've done that. So what about the $35 trillion in debt that we've accumulated with no end in sight?
Yeah, you tell me. I mean, we just keep kicking that can down the road. I think the estimates are $1 trillion per year of interest just to service that debt. And, you can't continually spend $6.5 trillion and only bring in 4.5 trillion in revenues. Now, I will say this, obviously, in their assessment of the Trump presidency and the debt that was created during his administration, when you look closer at the numbers, I think recently I've been hearing a lot about the $8 trillion he created during his time in office. But when you really get behind those numbers, Kerry, $4 trillion of that was COVID relief. And, his hand was forced in that. We needed help. Money was printed. The other half of that came from his tax cut, corporate America, from 35% down to 21%, which, generated a lot less tax revenue for the federal government. They were already spending that money. So that created part of the deficit during the Trump administration. The question is, moving forward, I guess I'll interview you. What do you think they're going to do?
Yeah, well,
pay that debt.
My gut feel is they'll put off the cut for longer than the market's expecting, because they've got basically rates, the long-term rates have come down. They've got enough leeway between the 2-year Treasury and the Fed funds rate, so there's no impetus there. So I think they'll just let it go. Maybe another month or two, who knows? But they'll let it go another month or two than expected. But eventually they'll cut. If they see the market weakening, I think they'll just start cutting, and they could say, well, we haven't changed anything. We told you we were going to cut. And their initial forecast is for 3 cuts. I've seen people say 6 cuts. Like you said, who knows what it's going to be? You're dealing with the Federal Reserve. And even though they try to tell you what they're going to do, it never quite works out the way they say it's going to, right?
Right. I think if you look at this, if you look at the notes after each of the Federal Reserve meetings, you wonder where the market bakes in these future rate cuts from reading the notes, because Powell uses language like, it's likely we'll do this. However, we're not going to, reduce rates unless blah, 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 blah. So it's all an interpretation. And I think if the markets sense that there's any chance of something, they're already baking in the stimulus and rolling the dice, knowing that it's an election year, like you said, and rolling with the fact that the Feds will fall right in line. And the fear of that is we might be right back where we were 10 to 12 months out. Maybe not, but it could reignite inflation if they do that. Now, I'm not trying to be Debbie Downer. It always sounds like I am, but I'm just trying to say that, if they reduce rates Yes, it'll help fuel the market even further, but it may also fuel the consumer who spends money they don't have on things they don't need, and that might reignite inflation again. So damned if you do, damned if you don't.
I think that's what it comes down to, no matter how you cut it. But at some point, I think it's inevitable. I guess we're going to see what happens next. Hey, David, just tell us where we find you, how we connect with you on the web.
You can find me at Wright Financial Group. That's spelled with a W, WRIGHT financialgroup.com. If you'd like access to more information and resources, you can reach us that way. My book, Bonfire of the Sanities, now out since December the 13th, bonfireofthesanities.com. Having some good information in there about how to make sure you're protecting yourself, your purpose for your money, moving into your pre- and post-retirement years.
All right, excellent. Well, we always appreciate you coming on. Hey, if you've got a question for David, myself, shoot me an email, kl@kerrylutz.com. The link to David's site is in the show notes of this interview on financialsurvivalnetwork.com. While you're there, sign up for your free newsletter. David, always a pleasure. Thanks for coming on.
Kerry, it's a pleasure. Thanks so much.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.